Today on Think Smart with TMFG, Mike and I are going to be discussing the end of the 4 pillars of finance.
Yeah, this is something I remember studying this back when I started to get into become a financial advisor, and that was 93 in that area, and you were even before me. And they talked about the 4 pillars of finance. And the 4 pillars were: 1, the banking system; number 2 was the trust companies; number 3 was investment companies; and number 4 was the insurance companies. And the big reason why finance worked were they were all supposed to be kept separate, and that gave a protection to the consumer. So along the way, it was to avoid any conflict of interest. So what happened?
Well, I think one of the first things that happened is the banks went and bought the brokerage firms.
Yep.
And that went on for a number of years. And they then brought those brokerage firms into the bank. Initially, they kept them pretty separate.
Yeah, I remember they were back then. They were
Right?
totally separate companies.
Early in my career, they were completely separate. There was the bank, and then there was the investment company, whether it was Scotia McClelland or Midland Wallwin, whatever it was. Then companies started to get a little greedy.
Yep.
And they saw all the money that those companies were making, and they brought it down to almost the branch level. So you could be a banking customer, and suddenly you're getting referred to the brokerage.
Yeah. Banks used to sell GICs. That changed, and they went into everything. And I mean, even from our point, I remember after we were doing mutual funds early on, right? And we had a securities license, and all of a sudden our company came up to us and said, we want you all to get insurance licensed, right? And we all went to take our insurance exams, and we got our, it took, the insurance exam at that time was about the easy exam you could ever write. It took like a half an hour to write the exam, and you left and you had your insurance license so you could go and sell insurance. Well, this is great, right? And then what they did, they went to all the insurance people and they said, we want you to be able to sell mutual funds. So all the insurance people went out and got their mutual fund licenses. But the next thing, we watched the insurance people. This was during the late 90s. All of a sudden, the market started to run into problems in 2000. They had not a clue what to do, right? And us with selling these insurance policies, as they got more complicated, we didn't have a clue what we're doing.
So you've got financial advisors selling insurance, don't really do a good job at it because that's not their livelihood.
Yep.
And you've got insurance agents selling investment products, and they're not really good at it either because that's not their area of expertise.
Yeah.
And they're very different markets.
Yeah.
They're actually very different people.
Yep.
And so that started to bring everything together. So, Mike, why is it, what's happened since then? Why was this kept separate before, and now it's sort of been merged together, and what's happening?
Well, it's all about corporate profits at the end of the day, right? All companies want to find every way you can make money in the type of business you're running. So if you're a shareholder of a bank stock, you see all this opportunity over there, well, you should be taking advantage of everyone. And I mean, we've kept up over the years. We have a specialized insurance person that specializes in insurance. We've done that in cases. Even along the way, I saw, if you remember when Canada Trust got bought out by TD, like it was the biggest trust company in Canada, got taken over. And if you talk about conflicts of interest, how can you have the trustee the same person that's taking care of your money? It's almost against the definition of what a trustee is supposed to do. The trustee is supposed to be neutral.
So you've now had a lot of these trusts merged into the bank. Now they still call them the trust. It's a separate division. You've had the brokerage merged into the bank. So now basically the bank can do everything.
They can now do insurance, they can do trustee work, they can do investment, and they can do debt and banking.
So let's look at the Canadian marketplace. We know we have 5 big banks. We know they control, I think it's something like 90% of wealth in this country. It's huge.
Yeah.
And there's only so many places to increase your revenue.
Yep.
So what if they're able to get a bigger pocket of their clients' dollars, a bigger piece of their clients' dollars? What if they can get their insurance, their banking, their investments, and even maybe if they're gone, maybe have access to a trust company?
Yeah.
That sounds pretty attractive. It's great for the shareholders. Is it good for the clients?
Well, originally they used to put in some rules in the bank, and I believe they're still there. It's called tide selling. So what tide selling is, it talks about if you shouldn't force people to buy one product if they need another product. And there was always laws and legislation about tide selling. And early on, when these 4 pillars brought down, there was a lot of conversation about it. Every time something would be tide selling, the government would go in and they'd say, no, you're not allowed to do this. It seemed that all those rules have been wiped. I don't hear anything coming in about it anymore. The problem we're finding right now is the banking institutions, from experience that we've seen, are not giving loans to people unless they give them their investment accounts. And that's a problem. We've seen personal experiences with this.
So I've got a great credit rating. My wife and I have a really good credit rating. We have some debt from when we rebuilt our cottage.
Yep.
I was very frustrated with my bank, which is, I'll call the Red Bank. I was very frustrated with them.
Yep.
And they weren't able to do some things. They put a new rule in. Whenever I deposited money, they'd put it on hold for 5 days. And my problem is I only get paid once every 4 months, right? Once every 3 months. So it's a big amount goes in. They'd put it on hold for what seemed like 2 weeks. I couldn't pay any bills.
Yeah.
So I had to find a new solution. I decided I was tired of my bank, so I went to a big blue and gold bank.
Yeah.
And here's what they said to me. Only will we take you on as a client if you move all your investment accounts over. I go, I'm a financial advisor. I can't move my accounts over.
Yeah.
They said, well, we're not interested in the small amount of debt that you have. It's not that small. It's $1.2 million worth of debt.
Yeah.
But they had no interest in it. And I said, so I talked to the advisor afterwards, and she said, we don't have an option today. We have to either manage the money or we're not taking on the liability.
Yeah.
You've had a similar experience. What have you done? You're looking at taking a mortgage on your new house that you're buying this fall.
Yeah.
What do? You're taking a different route.
Oh, I'm using a mortgage broker. So the mortgage broker is interesting because, number one, they're shopping for you. So it's nice to have someone acting in your best interest, right? So she's trying to get the best rate. And right now she has 3 or 4 institutions that she's cleared with. And she said, about 12 days before it goes, we'll secure in with one and we'll see who's giving us the best rate at that time. And the institutions aren't necessarily one of the big 5. There's a lot of other lending institutions that are giving better deals and better options for paying them off early for doing all this stuff. So I find that's a big. It's always important to have someone who's acting in your interest on your side, and that was a big difference in my experience.
One of the questions we get asked is, we've been reducing our exposure to Canadian companies over the years.
Yep.
And one of the reasons is the banks continue to become a bigger part of today's economy. And how they've done that is some amalgamation. But let's use some examples. MD, Asset Management, used to be a company just for doctors. They would help doctors put together a financial plan,
It was a good
manage
company.
their investments. It was a great company.
Yeah.
They were a tough competition.
Yeah.
If you had a doctor as a client, it was tough to get all of their assets over because they wanted to work with MD.
Yeah.
Since then, Scotia has gone and bought MD and then brought it in-house. From what we hear, it's not the same anymore.
Yeah. The models change.
Simply Financial is now owned by CIBC. Wealthsimple, who you think is this wonderful independent financial firm who's 10 years old now,
Yeah.
is owned by
Majority by Power Corp.
Power Corp, who also owns Investors in Mackenzie Financial.
And they have the insurance companies. Trust me, Power is in a bunch of the insurance companies too. So they're creating this whole big area where they're trying to. I mean, it's an interesting company because at least it's competing with the banks.
Yep.
So I'll give them credit for that.
It brings me back when I was at university. We studied some really great global product companies. And, when you go to buy Tide, you think you're buying it from one company. But really, they probably have 6 different competing products.
Yeah.
Some that are cheap, some that are more expensive, like Tide.
Yeah.
And so they've cornered the market when you go buy laundry soap.
Yeah. You think there's competition, but really there's not much.
And that's what's happening in the Canadian marketplace. So, Mike, what's the consumer to do, and is this good for consumers?
I mean, what you have to do is you have to make sure the person you're dealing with is looking after your best interest. You got to look for conflicts of interest. And you got to find out who they're working for and who they're being paid by, and make sure they're truly independent. We've always tried to make sure, even though we're just an investment firm, we've always made sure, or a financial planning firm, we made sure our investments are going through someone who's not affiliated. It stops that conflict of interest because you have to know why we're selling you the products we sell you. And you shouldn't look at the products and see the same name on them or an affiliated name. That means that we're selling them because our company wants them to. We pick our products and what's going to perform best. We're not worried about trying to stay with the company, towing the company line.
We brought in a couple of employees over the last few years, and we brought them over from the banks. Won't name anyone in particular, but the reason they left, the reason they wanted to make a career, not a career change, but a company change, they didn't like the pressure and they didn't like the conflict of interest. It's out there. I don't think it's a good thing. I don't think it's a good thing for the end investor. No one seems to be doing anything to stop it, to limit it. It continues to happen. And I think at the end of the day, the end investor is certainly going to be less diversified. They're probably going to be underserviced because you can't do it all. We don't do banking. Mike, you and I, you started in kind of banking.
Yeah.
But you can't do it all. You can't be good at everything. Today, you're better to pick a specialized company who's really good at something.
It was funny when we look back in the history when they talked about those 4 pillars, it was a great idea. And watching them fall down is really the collapse of what we've seen as great planning that was available,
That brings us to the end of another week. This is Think Smart with TMFG.